Welcome, everyone. Today, we're here to talk about Magnifi by Tiffin, a marketplace where you can harness real-time proprietary data to help individual investors and financial advisors find, compare, and buy investment products like stocks and ETFs, mutual funds, and model portfolios to grow and preserve your wealth. I'm Melissa Francis. I know just a little bit about this subject matter. I'm a former CNBC, MSNBC, Fox Business, and Fox News anchor. And you will remember, if you've watched us before, we talked about the best crypto investment strategies with Anthony Scaramucci, the best bond strategies with the bond king himself, Jeffrey Gundlach, and the best private equity strategies with Marty Nesbitt. Now we have a very special guest that I'm super excited about to talk about stocks and everything hot out there. Cathie Wood, she's the CEO of ARK. She is a board member of Tiffin, which is Magnifi's parent company. Cathie, thank you so much for being here. I want to drill down on your latest blog because there were so many good nuggets in there, and I found some of them kind of counterintuitive. So I want to get into those. But first, if I could take you to the hot story of the day, which of course is Twitter. And I wanted to ask you, looking at where things stand today, and I know it's fast moving, it keeps changing, but if you were Elon Musk, what would your next move be? What would you do from here?
Well, he's got a $54, I guess it's $54.20 offer out there. So I think he'll bide his time. It will be interesting to see if other bidders show up. I'm hearing that there are some. So let's see. Not quite sure. It's still quite fluid, right?
Yeah, no. And he says that if this doesn't work, he has plan B. What do you think that is?
Goodness, I don't know if it would be something a little more hostile. Just, I have no idea. You know, Elon Musk has his own mind and is I'm sure thinking very creatively about this.
If he does succeed and you were him again, what would you do with the company? What do you think that they need to correct?
Well, one of the things that I think has hampered Twitter is its advertising model. And this is what scares analysts out there. Oh my gosh, you know, he's going to upend the advertising model because advertisers don't like to have their ad shown next to questionable content, which is something different for everyone, right? And so this idea of perhaps a subscription service is a possibility, or a tipping service, but certainly open sourcing the algorithm will be the first thing he'll do so that there's transparency associated with what is and is not censored.
So do you think that's a good or a bad thing for the company? I mean, it might be a good thing for freedom of speech, or however you may look at it politically, but if you were a shareholder, is it a good idea for him to get that out there so everybody knows how the algorithm really works?
Well, I think even Jack Dorsey thought that Twitter was beginning to tie itself in knots over the censorship. And so he was trying to figure out, what can we do to overcome this monster, really? And so I think they do need to do something. Many people would describe what's happened to Twitter as becoming a cesspool. Now, we don't think that. We use Twitter. It's become quite important to our business, as have other social media platforms. And so we know that we can unfollow someone that is hampering our research or our ability to engage with others in a civil way. But I think that even Jack was saying, okay, we need a change. We have to change what we're doing. And I think he and Elon probably are aligned. And this idea of an open source algorithm, a shift away from the advertising model towards something more subscription based, and more transparency. I mean, ARK is radically transparent. Everything we do is transparent, and it has done nothing but help our business. Sure, you've got people out there who are denigrating our work, but we know those people, as we drill into what they're saying, they're not doing any research. We're really interested in engaging with people who are doing real research, and I think transparency would make our experience with Twitter even better.
Yeah, the fact that you're not afraid to engage like that and to, hear from those who might oppose you shows how confident you are about what you're doing. You have to wonder about a company that wants to hide what they're doing. Let me ask you though, on the Twitter front, so what do you think the company's worth? I mean, I know I want to talk to you about your Tesla target, but as you look at what Elon's willing to pay, what do you think if you had to put a price target on the stock 2 years down the road or 4 years down the road, what would you say?
Well, I think there's so much uncertainty right now that I couldn't give you one. Based on their existing model, our compound annual rate of return expectation for Twitter is roughly 25%. Now, their model is going to change. There are going to be a lot of dislocations. We have a lot of very short-term oriented shareholders who are probably now have moved into Twitter to make a fast buck, $54.20. But the model is going to change. And so we will revisit, once we understand what's going on, we will revisit the upside to the model. And we do think that a lot can be done to improve the model. But it may take more time than even our 5-year investment time horizon.
So if Elon Musk does get control of the company, would you adjust that upward? Do you think it has more potential with him in charge, or would it be more of a wait and see? How would you feel?
We probably would have more confidence in the platform, would want to hear what Elon has in mind in terms of perpetuating the platform. I'm sure he does not want to run it as a charitable organization or a nonprofit. So we'd like to see how he thinks it could become a very transparent, but also self-sustaining model. And, he's very creative. And I think that it is our global town square and that a lot of people would miss it. So I think there will be a lot of people very supportive and very open to his ideas.
So putting politics aside entirely and just thinking about pure money as a shareholder, you would be in favor of Elon Musk taking over?
Well, I do think that the route Jack was going, which we supported, was opening up the algorithm or open sourcing it in some way. And so I think this is a continuation of that. We also think one of the reasons we have held Twitter is because we believe it is a verification platform, the little blue check. And we believe that it could become a verification platform for NFTs as well. Mm-hmm. And so, there are a few call options here, and their verification algorithms we think are well respected out there. And so I think Elon would also build on that.
Wow, fascinating stuff. That's great. I'm sure you just made some news there without question. Before we stray too far from Elon, because he is such a fascinating character, I know that you put a 2026 target on Tesla of $4,600. Mm-hmm. How did you work that math, and how do you feel about that call?
Yes, well, we have been building out the Tesla model for years, of course. And each year we publish our 5-year projection. We started doing this, I believe, in 2019, when we believed Tesla was so misunderstood. And I think our projections were so much closer to the mark for 2022, 23, 24, that we felt that open sourcing it and continuing to update people would help them understand, number one, how much share Tesla has and is keeping in the electric vehicle space, how capital efficient the company is. We're even shocked at how capital efficient it is, more efficient than any other company out there. We keep a constant eye on batteries and battery costs and battery technology. So we like to update that. But I think our biggest assumption changes over the last few years have been market share, keeping a lot more than we expected, ability to scale. In fact, Elon is saying he's now a manufacturer of factories. That's one of their core competencies, and we agree with that. Mm-hmm. Capital efficiency, we've been shocked at how good that is. and their ability to increase their gross margins over time, much, much higher than I think most people might have anticipated. And in our 5-year forecast, whereas last year we had a 50-50 shot at autonomous being a reality. Now, as you can see from the model, we put a 25 percentile, 75 percentile probabilities, and we have price targets associated with those, sort of the low end and the high end. We know now that autonomous is possible because cruise automation is autonomous in San Francisco, a big city. Waymo has done it in Arizona. So it is possible. We no longer have to answer that.
Yeah, I can't wait to not drive my kids around, but I hear you. I want to ask you specifically about ARC. So tell us a little bit about your research process, the people you have working for you. I find it really fascinating.
We give our research away, not because we are altruistic, although we do want to educate not just investors, but parents and grandparents about how the world is changing and how rapidly it's changing, and how to keep their children and grandchildren on the right side of change. And even for adults, how to retrain. So much is going to change because of the 5 innovation platforms: genomic sequencing, adaptive robotics, energy storage, artificial intelligence, and blockchain technology. So much is changing. And those platforms themselves, they're all growing at exponential rates, and they are converging. So it's one S curve feeding another S curve. And we want people to understand that. We want not just investors and registered investment advisors, but also, as I mentioned, the sell side and the buy side. They're used to very short-term time horizons, and they haven't until recently been as focused on these new technologies. They've been much more focused on benchmarks and how to beat benchmarks. They haven't been thinking as much about the future and the technologies that are going to transform the future. So we give our research away because we want to engage with and become a part of the communities that are innovating. And I feel like we've done that. So yes.
If I could just jump in, because this has been a very successful strategy for you, especially during the pandemic and the lockdown economy. It's been tougher, obviously, more recently. And, you've seen a lot of correction within the portfolios, and, you've taken a lot of criticism from the outside. I would ask you, first of all, is there any part of the criticism that you feel like you're receiving that rings true?
So let me put in perspective what has happened over the past 5 years. We have a 5-year investment time horizon. So we'll start with the past 5 years, and then we'll look forward at the next 5 years. Past 5 years, as we stated in one of our research pieces recently, and fund pieces, very few active managers have outperformed the markets during the past 5 to 10 years. I think in the past 10 years, which is a recent study that we read, 11% of large cap managers have outperformed their benchmarks, and 25% of all active managers have outperformed their benchmarks. We have outperformed the NASDAQ, the S&P, and the MSCI handsomely over the past 5 years. I think our compound annual rate of return is around 22%. So that's the past 5 years. Then we go into the pandemic and the crisis period. We had, for about a 6-week period, a significant risk-off episode, and we underperformed, as we usually do in a risk-off period. And then from the bottom of the coronavirus to the peak in February of 21, our flagship strategy was up 360%. Since then, at our worst point, we were down 60%. So I just wanted to put that in context. If we are right, now I'm talking about our innovation platforms broadly. We believe that disruptive innovation in the global public equity markets is valued today at about a $10 trillion market cap. And we believe that is going to 210 trillion by 2030. So that's anywhere from a 35 to 40% compound annual rate of growth for those platforms. And we would hope to outperform because we are focused only on the future, and we have centered our research and investing around those platforms. When people talk about risk management, they seem to think that we're a generalist kind of asset manager. We are not. We are focused exclusively on disruptive innovation. And when they say, where is the risk management or the risk control? We have many levers of risk control, including our partners who oversee the risk in their portfolios. And I'm talking our minority partners and our distribution partners. So we are fielding questions and are thinking carefully about the risks we're taking, certainly in the context of the questions we're getting. But it's been built into our scoring system, our top and bottom, top down and bottom up modeling. There are risk assessments each step along the way. I think many people confuse generalist portfolio managers who have to shift between this sector and that sector, or between cash and no cash. We're not doing that. That's
okay. And so I absolutely hear what you're saying. And I'm wondering, is that the same as you wouldn't do anything differently in terms of, what about even in the approach with the media and the way that you've engaged people? You talked about social media and elsewhere. Is there anything that you would do differently, or do you feel like everything's going according to plan?
So after one of the rougher interviews out there, I was trying to figure out, why don't they understand how we are controlling risk? And one of our clients actually said, well, you sounded like, you wouldn't do anything differently. We actually do. When we move into these risk-off periods, we concentrate our portfolios to our highest conviction names. And what that means in this last go around for our flagship strategy, we went from 58 names in that strategy to 35. So we basically said, from a risk control point of view, that, okay, using our scoring system, where is our conviction the lowest? They're all getting hit equally, practically, in this risk-off period. So why don't we push towards the higher scoring names? And it gives our analysts and me and our associate portfolio managers the psychological wherewithal to say, okay, this is a risk-off market. All of our stocks are being treated the same. Mm-hmm. Why don't we come out right now with all of our concerns lurking deep down inside, and then concentrate? So we do take risk off the table. And if you look at long-term studies, they will show you that the most concentrated strategies are the most successful, because typically active managers have a very high degree of confidence in several of their names, but there are a lot of names. There'd be the tail of the portfolio where they just don't have as much confidence. So we use the volatility to curb the risk by further concentrating our portfolios. And the only thing I'll say there is, many people say, wait a minute, that's not risk control. Concentration is higher risk. We disagree.
Yeah, no, I'm glad you explained that, because that is really interesting. And I'm not sure a lot of people out there understood that that's what you were doing. Yes. Just in terms of some of the personal attacks. I mean, for example, when I saw Morningstar's downgrade, they were focused so much on succession, which, obviously it's important, but there've been a lot of other funds out there and fund managers that they haven't had that same criticism and focus. Do you think it has anything to do with your gender? Do you think it's sexist at all?
I really don't. I do know there are companies like that one that do not understand what we're doing. We do not fit into their style boxes. And I think style boxes will become a thing of the past as sectors, as technology blurs the lines between and among sectors, and as innovation goes global and goes across the cap range. So I think those style boxes are going to be, will seem quite provincial at some point. We are index agnostic. That is a big problem for many of these companies. our objective is a minimum compound annual rate of return of 15% at an annual rate over the next 5 years. We are the closest you will find to a venture capital company in the public equity markets. And I think organizations like that one have a very difficult time like that. They've never seen an animal like ours, where we are thrilled that our active share relative to the broad-based indices is in the high 90% range. We have, if you look at technology in the S&P 500, we have no overlap. We are doing something different. We are saying the technologies of the future are going to be very different from the technologies of the past. And so we offer a good opportunity for diversification for registered investment advisors. They own the FANGs and Microsoft, NVIDIA, and now even our beloved Tesla, because it's in indexes. But they don't own our stocks because they're not in these broad-based indices. So I think much of our success, because we have had, despite the performance we discussed earlier, we've had inflows. Last year, 17 billion in inflows. This year, we're still inflowing, even though we've been in this basing period and no one's sure if the next move is up or the next move is down. But we are in inflow. And I think that's because advisors know we are a diversifier and we will protect them against the value traps that we believe are populating broad-based benchmarks, which are becoming part of their core portfolios. We are a hedge against the disintermediation of the old world order.
Yeah. And just to clarify for people that are watching, so you have your inflows have exceeded your outflows. You have more people coming in, more money coming in right now?
Yes. We are in net inflow mode. Yes.
I'm also fascinated. I mean, you're so contrarian, and I do think that your fund, if you truly understand what it's about, it sort of becomes, we've talked on this show on Magnifi a bunch of times about how the old model of, you know, however you want to slice it, the 40-60 is really broken, and that you have to have a whole bunch of different approaches to your portfolio, and having a slice of what you do is something that is so different from what you would get elsewhere, and is backed by huge brain power and huge research, that it's a way to take, you know, this oppositional point of view almost, but do it in a very smart way. Along those lines, we talked to Jeff Gundlach a while ago, of course, Bond King. He was saying that, you know, he's really, obviously a lot of people are worried about inflation right now. I read, I think it was in your blog, or I heard you do an interview, you talked a lot about the possibility of deflation a year from now. Walk me through that.
Sure. And before I do that, Melissa, you hit on something that I think is critically important. The analyst team that we have focused on truly disruptive innovation is unmatched out there. I am sure of that, because it is our sole focus. We have domain experts. We do not have MBAs. It is much easier to teach a biochemical engineer or a rocket scientist how to read financial statements than it is to teach MBAs biochemical engineering and rocket science. This is a throwback to the Bernstein days. Sandy Bernstein set up his company with that in mind. And I think it's absolutely right when it comes to innovation. So now I have to... Deflation. Well, disruptive innovation is inherently deflationary in two ways. One's good, one's bad. The good way is truly disruptive innovation follows learning curves, which are expressed as cost declines over time. And as costs decline, demand increases for new technologies, and more people around the world have access to them. So they can reach mass markets. And that's what causes exponential growth. The costs decline, they open up a new market. Costs continue to decline. Even so, we're seeing massive opportunities from those 5 platforms. The other side of disruptive innovation is creative destruction. And this is a little bit back to what I said before, but a lot of companies in the broad-based indices in particular are very short-term oriented in terms of wanting to cater to their shareholder base. And so we have watched them for years, especially since the tech and telecom bust and the 08-09 meltdown and the risk aversion that pushed everyone towards these benchmarks. We've seen companies cater to that short-term shareholder by manufacturing earnings, buying back shares to increase earnings per share, or paying dividends, but they've leveraged up to do so, and they haven't invested enough in innovation. And so we believe that another source of deflation, secular deflation out there, will be bad, and that is these companies' products going obsolete. They need to service their debt, and to do so, they'll have to cut prices. We think that's going to happen to the auto market big time, the gas-powered side of the auto market. The big disagreement today is cyclical inflation, and we believe it is in the process of peaking. And we also believe some of the early signs that we're seeing, whether it's mostly in inventory accumulation, especially in the retail world, excluding autos, the inventories are piling up. And because I think many retailers and maybe wholesalers double and triple ordered when they couldn't get supplies because of supply chain issues, that they are going to end up with so much inventory on their balance sheets that they're going to have to cut prices dramatically. Now, of course, we have oil prices as the outlier here. Oil and food with the Russian invasion of Ukraine, the breadbasket of Europe, and of course, Russia being such a big factor in energy. We think that demand destruction is underway in the energy sector, seeing a lot of substitution. I see a lot more bikes in St. Pete and scooters, and and I see people deciding to make fewer trips to the grocery store each week and what have you. So we're seeing downright demand destruction, and we're seeing Russia hasn't been turned off yet. It still may be. Europe may stop, but we're seeing that its oil imports are going, or exports are going elsewhere, and we'll have a reshuffling of where how the supplies get from one country to another. So I actually think I was surprised to see in early March oil prices peak out in the 130s. And then they tried again and they peaked out in the 115, 117 range. So let's see if that could be. Lower highs are often the first sign that demand destruction is beginning to have an impact as supplies are starting to increase, including production in the United States.
Yeah, we just talked to Mark Fisher a couple of days ago, who of course is master of that space, and he said similar things. And actually, if you listen to him, he had said that nat gas was going to explode, and it had a definitely, that was a prescient call at the time. So it's interesting to hear you talk that way about energy and also about the supply chain. That makes a lot of sense, because this idea that you can't get what you want has been going on for a long time. And I know that you also said you have a consumer that doesn't feel particularly good about his or herself right now. In addition to that, the fact that wages aren't really keeping up with the prices that you're seeing out there is another reason why we could see these supplies stack up. A final word to you on that. And maybe I don't want to forget to ask you where you see the 10-year bond trading a year from today. So those two things real quick, if you don't mind.
So the consumer sentiment, I don't know why many people or many economists, strategists are not focusing on this. University of Michigan Consumer Sentiment Survey, which I've watched it for 45 years, is the best out there at measuring consumer sentiment, is down to levels that we have not seen since 08-09. In 08-09, people were losing their homes, losing their jobs, losing their cars, and oil prices were at $147. And here we are, they're feeling that badly. That tells me this idea of velocity, the velocity of money, consumers not going to be racing out to buy because the consumer is becoming risk averse. That's a recipe for a continued decline in the velocity of money, which diffuses the inflationary impact of the reserves out there. So that's the first thing I'll say. I think we could end up in a global recession. I think that there's such a fine line now. I think Europe's in recession. China feels very recessionary to me, which means Asia is going to catch a cold. We're seeing and these are canaries in the coal mine, but Sri Lanka, threatening to default. This is like the beginning of the Asian crisis in 1997 when the Thai baht devalued. So, I think there are a lot of warning signs out there. And so is the US going to fall into a technical recession or not? I don't know. I don't think it matters. I just think there's a lot of weakness out there. And then finally on the bond yield, I think it's been really interesting as the Fed has been talking up interest rates, that the 10-year yield has not been able to even crack 3%. So we're in the 2.5% to 3%. This is the 10-year Treasury yield. And I believe that inflation is going to start unwinding pretty rapidly now, because if you look, if for no other reason than the base effect, last April, the CPI was up 0.9 and the PPI was up 1 or 1.1. Those are the comparisons. Now, if we come in below that for April, then both of those year-over-year comparisons will come down for the first time. And I'm seeing a lot more economists saying that they think inflation has peaked. And now the only question is how low it will go. And we think the surprise will be on the low side of expectations for cyclical reasons, inventory as I just described, as well as secular reasons, disruptive innovation and creative destruction.
Yeah. It is such a pleasure to talk to you. Thank you so much for doing this today. I think everybody out there really gained a lot from it. Thank you for joining us. For more information on ARC, Cathie Wood, or anything you've heard today, please go to magnifi.com/media. We'll be right back. Welcome back. I am joined by Gary Kaminsky. He's former vice chairman of Morgan Stanley, former capital markets editor, CNBC. Gary's also an investor and a board member at Tiffin. And Gary, thank you as always for being with us. That was a tremendous interview with Cathie Wood. She had so much to say. I know that you were listening to all of it. And what's cool today is that we can show people how to use Magnifi to do sort of a deeper dive into funds like hers and see what's going on, right?
Yes. Well, in the past, Melissa, we've looked at Magnifi to try to identify ETFs or mutual funds based on some investment thesis, such as getting long natural gas. Last week, we discussed with Mark Fisher. But we could also use Magnifi to identify characteristics within a portfolio. So for example, I'm going to type in here, exposures to innovation. Cathie obviously talks about innovation. And if you type in exposures, I want thematic ETF with exposures to innovation, sort of by relevance.
Right.
And you go to the drop-down menu, you'll see that brings up two of the ARC, not surprisingly, two of the ARC portfolios, ARC Innovation and the Next Generation Internet. And then if you break it down further, you'll see what the bets are in terms of sector bets. If you're a financial advisor, this is extremely helpful in you trying to figure out where ARC might fit in. I do want to make one point on the interview. I've spent, as you know, many years managing money. And guess what? When I managed the Neuberger Berman All Cap Core Fund, which was in the top 2 or 3% of all managed accounts in terms of decile, we didn't fit into a style box either. It was an all cap fund, and professionals know that just fitting into a box to closet index is not how you create long-term wealth. But she made a very good point, and I don't want viewers to miss this. It's not the responsibility of the portfolio manager in terms of risk management of the client's portfolio. It is the responsibility of the investment advisor to determine how much of a person's portfolio should be in a certain asset allocation, right. Whether it's crypto, whether it's an aggressive stock fund like ARC Innovation, or whether it's too much energy exposure. So she's doing what her mission statement says she's trying to do, which is find very high growth companies that are disrupting what is happening in various marketplaces. If you put 30 or 40% of an ARC Innovation portfolio in your client's asset allocation, shame on you. And I just want to make that point because I think it's something that the business media, unfortunately, Melissa, you and I both know, many people in the business media who do these interviews have never managed money.
Right. And don't actually invest. So they don't actually understand what it is that they're talking about. And she was making that great point that she's very transparent. She's very specific about what she's doing. She feels really confident with her strategy, what she's followed, that what she encounters is people who misunderstand exactly what it is that she's out there to do. And maybe, put all their eggs in her basket. That's not what she's about. That you and I have been talking about this so much over the past couple of weeks, is that the old model is broken, and you have to have really specific slices going into your portfolio. And she's got one of the hottest, most fascinating, but like you said, buyer beware. If you put all of your clients' money into her fund, that's not what she's set up to be.
She's
right?
She's not asking you to do it, and she's not telling you to chase the high performance. This is a specific asset allocation, much like we discussed with crypto, much like we discussed with private equity. The whole purpose of what we've been trying to do here is to show how we use Magnifi to help identify the themes. But remember, you have to be responsible for asset allocation. You can't blame everything on the fact that you're just trying to mimic the benchmark. And then when you want to take an oversized position, you talk about the relative performance. Great stuff with Cathie. I've seen her quite a bit on TV, Melissa, as you pointed out. She's done a lot of business media. This was the most transparent and best interview I've seen for a professional investor, understanding exactly what it is they're trying to do at ARC.
Well, thank you. And we'll see what happens with her. I mean, she's very contrarian. Her calls on deflation, what she had to say about supplies stocking up in places, inventories, I thought was really fascinating. And also, of course, everything she had to say about Tesla. I know we made some news there, and I, for one, am fascinated by her calls. Gary, thank you so much. We want to thank our guests, Cathie Wood and Gary Kaminsky, today, and make sure you all visit magnifi.com/media to help identify the best private equity ETFs and all the best plays to grow and preserve your portfolio and your clients' portfolios. I'm Melissa Francis. Thank you for your time.